Head and Shoulders bottom using Fibonacci retracement levels. We have this downswing. Price forms a low. Distinctive change in direction here. Forms a low right here at the 10-day moving average. It rallies beyond the last level of resistance. But what do we like about this rally here? What is distinguishing about this rally? It's a nice 100 pip run, but look how deep it is in comparison to the last level of resistance. Price comes back, finds support at the last level of resistance, which is also the 38% retracement. It is also a central pivot point, which we can't see here. But in addition, it's the figure. 7,500 the figure, and which is an item we're going to talk about shortly after this section. Look at how price respected the figure along the way here, and it's a natural support resistance level. Then we see our next leg up. Now the Australian dollar, it's a 4-hour chart, and the ranges on the Australian dollar are really quite narrow, and the Australian dollar also likes the 50% retracement for some reason. We see here price forms a low. We have our key reversal day. Our key reversal day retraces to the 38% retracement, support and resistance, 10-day moving average, and then kicks up into a rally, 162% extension. From these highs, look at this. We have a high here. Price comes up to the highs and retraces. It retraces to the lows. Then we get this errant wick here, which is possibly some stop running below these lows. It's a logical place to put stops on an institutional level. We have an errant wick down below the lows and also through the 10-day moving average. This is the 50% retracement, but price is more or less holding at the 38. And then we see the price kick up into its new rally, holding above the previous highs. We have this this narrowing V formation here. It's just a small technical tool that we use. When we see a parabolic run like this, we watch for the breakdown of this trend line, of this parabolic trend line, because the more parabolic this gets, then the higher the probability we're going to see an aggressive breakdown. The faster this moves up, the thinner liquidity gets. So we see a rising price on drying up liquidity, then we often will see an aggressive move down afterwards. As price continues to make new highs, we pull our Fibonacci tool from the low to the new high. Price retraces to 50%, then kicks into a new rally but finds resistance at the last level of resistance, which is also that still that 162% retracement. We consolidate for a period, then move into another one of these parabolic pennant formations as price breaks down. But look at how price moves out of consolidation, comes back to resistance, support, rallies through, comes back to support, rallies through. Now this is very toppish. Look at the doji and look at the wick here, very, very toppish formation, and we start to see a breakdown through and a slowing trend and consolidation continued after this. Amazing stuff, folks. This is amazing. If you are dialed into this stuff, you will make so much money that you won't know what to do with it. You'll be taking such large position sizes, you won't know how to handle it. This is incredible. This is another Australian dollar 4-hour chart. price falls, comes up, makes a high, quickly rejected at the high, price falls, makes a new low, retraces, bounces at the 38% retracement level, comes all the way up and forms a sweet, sweet long candlestick hammer at the 62% retracement level. And you see this doesn't quite fit in the screen, but it's a level of support, becomes resistance at 62%. And look at the fall after the breakdown. You can use various trend lines and so forth to analyze this trend line, but this breakdown. But if you look at this, you see the consolidation here. Remember, this is a 4-hour chart, so if you look at it on an hourly chart, it's going to be 4 times as long. And look at this consolidation and see how price moved through, rallied back up to the base of consolidation, and then fell. And we see these small swings on the way down, and we see a base of consolidation here, and price moved below the base of consolidation. Price is getting exhausted here at 162% extension. We have a retracement rally to this base of support at 7,200. Then price falls, consolidates, continues to fall. The trend is getting weak. One last spike down. This is actually, you would actually look for a head and shoulders at this stage, but price continued down, one last leg down to the 262% extension. Key reversal day, rally, and retracement to the 38% and 10-day moving average. Often the 10-day moving average will help to define these reversal formations. So we have this convergence of 10-day moving average, 38% retracement, and resistance and support. We have the market is in a state of divergence at this low right here, this spike low. We rally to 162% extension, and then price action starts to get tired. Amazing, amazing, amazing. Here's the euro yen, and I'm using these various currency crosses. One reason is because I want to bring them to your attention, because each of these currency crosses has its own character. They trade in different ranges, and they've got their own life. They have their own character in terms of ranges, what stimuli they respond to concerning short-term data, and the internal geopolitical environment. And so it's important to get familiar with the different currency crosses and how they respond to the various stimuli, because even the euro yen will respond somewhat to US dollar economic reports, because they are remotely related. Because when you start to have US dollar buying against the euro, it affects the price of the euro, and then it will affect the price of the euro in relation to other crosses as well. And it's important to understand those relationships, and hopefully I can get some of that information into some of these CDs as well, just defining some of the interrelationships. Euro yen falling, forming a base of support, consolidates, makes a move down. The base of support provides resistance to the next leg down, and when we come back up here and meet this level of resistance, that is a minor reversal formation, and then price comes up to beyond this base of support, which is further confirming a reversal. We now have a nice leg up to draw some technical information from. We pull our Fibonacci's, and when our Fibonacci's are pulled, price, we line up with this left shoulder here, and then there's a left shoulder over here. And before this forms, we actually begin to stock the trade. You can actually, there's a possibility you could look for a trade here at the 38% retracement, because it almost aligns with this level of resistance here, which The level of resistance here takes precedent over the Fibonacci number. Errantly, we see this spike all the way down, likely in response to an economic report, and a very aggressive spike at that, but technically it all lines up. Whether or not there was a trade here, it's tough to say. The market was in a state of MACD divergence. Price rallies and does not make a new high, yet retraces and consolidates before it starts its next leg up. Bit of a messy price action, but I just wanted you to see that it's making technical sense. And it makes technical sense all the way to the point where it comes to fruition at the, this is a mistake, this is 162% extension, so change that in your books. And it comes up to the 162% extension and the 10-day moving average, where we see a bounce and consolidation. Let's have a look at a Gartley pattern in an overall reversal formation. We're getting technical on you now, aren't we? When you started listening to these C's, you maybe have thought it was a little bit too simplistic for you, but now we just need you to stay with me now. We have prices falling, and we have a nice retracement, some smaller price swings. We reach a low point here. Of course, we don't know it's going to be ahead until price comes all the way back up to the last level of resistance. We fall to the 38% retracement and resistance here. A minor bounce, more or less, it's just binding itself into a range of consolidation as price becomes satisfied with its valuation. Then as the next trading session opens up, we see a leg down to the 62% level, which is a defining support and resistance. And you see this swing down here from this high to this low. We swing back 79% and then down 162%, which converges with the 62% retracement level of the big swing, of the upswing, and the defined support and resistance level here. Price wrestles with that level, and if you entered here, you want to take profit right away. It came down and tested one more time, which is a confirmation, and then we start to move up from there and failed to hold the highs. Price is very choppy. We come down on the new upswing, looking at the swing from the low all the way up to the high. Price retraces 50% and to the trend line support and is stimulated by an economic report at the height of the UK session, and then finally moves out of range. And the reversal formation comes to fruition and extends intraday to 162%. But what I want to point out in this chart is that it can look quite messy. And how do you pick up on these patterns? Well, the overall reversal pattern formation here is just going to give you a slight twinge of sentiment in your assessment of the next move. And when we have this twinge of sentiment, we are still, once we see this deep retracement and start to look how price is struggling with moving lower, forming the right shoulder, then we should be thinking long. Especially if everybody else is thinking short, we should be thinking long. I did not draw a trend line here, but it appears to me that if we draw a trend line from here through here, this comes to the back side of the trend line. Years ago, it was children who didn't know the value of their currency. Now it is nations.